Now let's take a look at a bearish option strategy where the odds may actually act in your favor. When I'm looking to put on a bearish options trade, I want it to coincide with a negative fundamental picture for the company. Remember the saying, the trend is your friend? It usually refers to technical analysis, but it's also true for fundamentals. In this section, you will learn how to adapt the vertical bear call credit spread to your hypothesis and assess the outcome of applying this spread to your strategy. So now that we've covered a bull call spread, let's go ahead and take a look at a bear call spread. Your hypothesis needs to be that you believe the stock is going to underperform the market in the future. But the bottom line is you need the stock to have a negative downside catalyst. You basically need the stock to fall in order for this spread to make money. So let's go ahead and talk about the definition. This is commonly referred to as a bear call spread. Okay, it's bearish because you expect the stock to fall. The way you set this trade up is you're going to sell one call while simultaneously buying another call, same expiration, but of a higher strike. There's a trade-off for this. You're going to receive less premium, but in return, you're going to be able to cap your downside losses, which is attractive. That's why we like spreads. So let's go ahead and look at the P&L graph of the bear call spread. So here, we're going to put our P&L graph, and you'll notice it's kind of the reverse of the bull call spread that we saw earlier. There's 3 points that we want to focus on. Those are those horizontal lines. So the first one is going to be the maximum profit that you can make on a bear call spread, referenced as $200 in this chart. The max you can lose is referenced as $300 in this chart. And again, that's what you need to focus on, is how much can I make? Look at this line, this horizontal line. How much can I lose? You look at this horizontal line. But again, where is that break even? Where do I actually start making money or losing money? Well, there's a formula to calculate that as well. So let's go ahead and look at our formulas real quick. So again, bear call spread, what's your max loss? Your max loss is simply the call spread width minus the premium earned. And remember, we're talking about one contract, so you'll multiply times 1 times 100. So that's the max that you can lose. The max that you can gain, or your max upside profit potential, is simply the premium earned times the number of contracts times 100 shares. So again, premium earned is the max that you can make. It's very similar to if you were to sell naked options. The most you can make is the premium that you receive. Lastly, let's talk about break even. The break even is simply taking the lower strike, the lower call strike, and then adding the net premium earned.